Okay. So I'll go ahead and get started. Thank you all for joining us for our Opus Connect webinar series. We have a great panel lined up for you today. The topic is tough questions PE firms need to be answering right now. So really looking forward to that. Before we begin, we have a few housekeeping things that I want to get through, and I'll try to move through those quickly so we can get to the discussion. So if you're not familiar with Opus Connect, we are a lower middle and middle market M&A focused organization. We're membership based. We have chapters in LA, Chicago, and New York. When we're not sheltering in place, we are in one of those markets every month doing a panel or a roundtable. In addition to those events, we also do our Deal Connect, which are more all-day conferences, deal sourcing events. So if you're interested in learning more about us, please reach out to my colleague here. Marisol, if you could go to the next slide. Jacob Zeffrin, he'll be able to assist you with any further information. And before we get to the good stuff, if you could go to the next slide, please. We will be having an option for Q&A at the end. We'll set aside about 10 to 15 minutes. So if you click at the bottom of your screen and you enter a question there, our moderator, Tom Goldblatt, will be going through those at the end and pick a few that we can answer. So please enter your questions there. These events, next slide please, would not be possible without our sponsors. So I do want to give them a chance to speak, and bear with me because I'm going to have to find them. Fran, if you're in here from Alliant, please raise your hand and I will give you a moment. And if I can't find, let's see, I see Nate in here. Let's see if Nate, do you want to say a few words?
Yeah, hi, can you hear me?
Yeah.
Thanks, Lena. Fran couldn't make it, but yeah, obviously appreciate everyone jumping on. There's a quick overview on who we are, what we do, but simply the largest specialty insurance brokerage firm in the country with, I think it's over 100 offices now. We've probably got about 4,000 home offices as we speak, but fully functional online and helping people throughout this from an insurance perspective. A lot of questions around that. But again, appreciate the opportunity, appreciate people joining.
Absolutely, thank you. Derek from Baker Tilly, do you want to say a few words? Derek, are you there?
Yep, can you hear me?
Yeah.
Yeah, so Baker Tilly is a full service accounting firm. Also have Baker Tilly Capital, boutique investment bank. All 4,000 of us have been working from home now for about a month now, kind of the settling into the new normal of things. We'll add that, we've been doing a lot around navigating the small business loan environment, and some kind of rapid recovery and growth services, scenario planning, execution, demand and supply planning, kind of safe return of workforce, things like that. So those are some new evolutions in some of the services that we're providing.
Awesome, thank you. Marisol, let's go to the next slide, please. And I'd like to introduce Jason Byrne with Brian Cave. They are typically our host in Chicago. Obviously, this is a virtual event, but I do want to give him a chance to speak. So Jason, do you want to say a few words? Jason, are you there?
I am.
There you are.
Yeah.
Go ahead.
All right, thanks. So thanks again for everyone for joining. Obviously, usually we are welcoming you into our offices. It feels a little strange to welcome you into your own home office, but again, thanks for joining. As it says right there on the screen, we've got 1,400 lawyers around the world. In the States, and particularly in Chicago, we really focus on middle market, M&A, finance, and restructuring transactions. We do have a full service around the country and happy to make introductions. Importantly, I think for this moment right now, I'd like to ask people to, if they have any questions, please go to the briancave.com website. On that front page, we've got a lot of really good resources for COVID-19. We've got a task force and really putting together a really good set of specialists. In fact, right now, while we're having this conversation, my colleagues are hosting a teleconference on the payment protection program to educate clients. So if you have questions, feel free to start there and or follow up with me directly. And thanks again, everyone, for joining.
Cool, thank you, Jason. So before we get into the discussion, let's go to the next slide. We do have a poll. We're going to be asking a few questions throughout the meeting today, and do encourage your participation. Let's launch that first question. We want to know how you heard about today's event. So you'll see a poll question pop up on your screen momentarily. We'll give you a few seconds to answer, and then we'll review the results and move on to the next. So let's launch that poll. There we go. Is anyone seeing the question pop up?
Not yet.
Okay. Let's give it 1 second, and if it doesn't work, we will move on.
We have a couple votes coming in, Lena. This is
Okay, awesome.
It's not on my screen.
Okay. Marisol, are you seeing the results come in?
Yeah, about three responses.
Okay. I think we're going to move past this one. It was a good idea. We'll get it next time. So let's go to the next slide here. And I want to introduce our moderator today, Tom Goldblatt from RAVINIA Capital. Thank you so much for leading the discussion. We put together a great panel, and I'm going to stop talking and kick it over to you, and let you move forward. So thank you.
Well, thank you, Lena, and thank you, Opus, and all the sponsors, and thank you for all of you attending. I'd certainly be remiss first without starting to to say I wish everybody is staying safe, and it's scary times, but you know, hopefully everybody is social distancing properly, and let's get started. So I'm the Tom Goldblatt, managing partner of RAVINIA Capital. We're a investment bank that focuses on mostly healthy deals, but we focus mostly on distressed deals, which we've been doing sell side and finding capital. It's been somewhat lonely over the last several years in this wonderful market, but I don't think it's going to be quite as lonely as a lot of people probably will rush into to the distressed M&A now. We've got a great panel of real life experts that are managing companies, investment banks making loans, and we want to make this a very useful webinar. Appreciate Opus putting this together. So having said that, I'm going to let each of the panelists introduce themselves so you can know who's talking to you and where they come from. And then we'll circle back and find out what they've been doing in this crisis with their portfolios and with their work. So having said that, I'll start with Brett, and we'll move down the line so each of the panelists can introduce themselves.
Thank you, Tom. My name is Britt Terrell. My firm is Backbone Capital. I'm a capital raising advisor based in Los Angeles. My former career path, I was at Foothill Capital as an underwriting manager, and then at the Gores Group, in private equity firm in Los Angeles, doing their debt capital raises. But in 2011, I founded Backbone Capital. So we are a capital raising advisor, raising senior debt, junior debt, minority structured equity, in some cases majority control equity, but more in the lower middle market. So most of the deals that I finance range between 10 and 30 million of capital being raised, really all over the capital structure, and probably in a little bit more challenging situations. But 9 years now as Backbone, and enjoying it, and of course have seen from the technology bubble in 01 to the recession in 09 to here we are in the COVID in 2020. So seen my shares of difficult situations. I tend to work in them anyways, but we'll talk deeper as we go forward.
All right, thank you. Tim?
Thanks, Tom. Hi, my name's Tim Lewis. I'm a partner at Southfield Capital. We're a private equity firm based in Greenwich, Connecticut. We are currently investing out of our second fund, a $200 million fund. We focus on entrepreneur-built, lower middle market business services companies. Within the lower middle market, we're focused on, I would say, the sort of the smaller end, 4 to 12 million of EBITDA. Most of the companies we're investing in, when we get involved, are $4, $5, $6 million of EBITDA. Nice businesses, but often quite raw. A lot of opportunity to professionalize, institutionalize. We're pretty hands-on. We focus, as I said, in business services. Within business services, we're pretty industry agnostic. Current portfolio has a industrial services business, an IT services business, a security business, a real estate services business, a marketing services business. The reason I describe that is, each of those businesses has been impacted differently by COVID-19. I'm sure everyone out there has similar experience where some of their portfolio companies are weathering it pretty well. Others are struggling more, and makes it even more complicated as you think about where to deploy your resources. So looking forward to the panel discussion and kicking things off. Thanks.
Thank you. Paul?
Sorry, trying to find the unmute button. Good afternoon, everybody. Hope everybody's managing well during these times. And I don't think I've ever said this before, but it's a pleasure to be socially distant from all of you. Again, my name is Paul Manzano. I work with AKSTON Industries. We are an investment holding company focused on acquiring and operating industrial companies, particularly manufacturing, distribution, and infrastructure services. We have relatively an open mandate, but for the majority of our portfolio, we're long-term oriented with no preconceived timelines for exit. So we've been in the thick of this with much of our holdings in manufacturing over the last few weeks. So we've had our hands full trying to navigate this market shutdown and dislocation, but also in terms of minimizing downside, looking for opportunities to take advantage of the dislocations that are occurring in real time. So eager and excited to share some of my thoughts.
Excellent. And finally, Kevin?
Okay, my name's Kevin O'Shea. I'm with KINSALE Capital Partners in Chicago. KINSALE is 3 partners. We're a merchant bank. We put our own funds into our investments, and we also act as a fundless sponsor. In preparing for this today, I realized that today is my 40th anniversary in business. I joined Beatrice Foods Company way back in April 9th, 1980. So kind of a coincidence. And I've kind of come up the CFO route. I was the CFO kind of in the early 90s. And after that, I did some turnaround work, which is going to be helpful, I think, as we go through the next couple of years here. So we also have at KINSALE, we have a relationship with a fund manager that manages over $1 billion for family offices. And they're looking for deals where they can write a $100 million check. We're helping them. So we think there's going to be some balance sheet repair that's going to go on in the future here. So we're kind of setting our sights right now on distressed and some larger deals. And the last thing I'll tell you is I've never had a beard. And when JB canceled St. Patrick's Day, I decided to grow a beard until St. Patrick's Day can be celebrated in the proper way. So no beard and no haircut, but it'll be gone when we can get out for a pint in the next month or so.
It sounds good. Let's try again if we can, the next question. We want to see, now that you know who the panelists are, let's see who's in the audience, see if this works. So we'll pull up the poll question. And,
Yeah, looks like this one's working, Tom.
excellent. Well, we'll give it a couple seconds and we'll pull up results. Okay. Are there results in?
You're still coming in.
Okay. Well, here we go. Okay. So we've got pretty even split, a little bit more service providers, but we have pretty even split between independent sponsors, investment bankers, capital providers of equity, debt, and others. So a real good assortment of viewers. So we'll try to make this useful for everybody. So let's get right into it and find out, what's, since this crisis has started, what steps you all have been taken and can recommend to others. So we'll start with you, Paul. Tell us, how you approach this and what's been going on with your portfolio.
Sure. So this, obviously has been a situation that's evolved within the last few weeks. And I think really the first cue that we had was back in late January and early February. And so one of our companies has some raw materials exposure. We utilize a fair amount of tungsten carbide. And so that was really the first thing that hit our radar screen in terms of how to secure that. So we, went out to our suppliers. We got a better understanding in terms of what their supply chains look like. We did a little bit of forward purchasing and just made sure that we had enough inventory to carry us through in case the situation deteriorated. So that was really the first baby steps that we took as this crisis took hold. I think we started communicating more closely with our vendors. Once we got through mid-March, that's when we realized that things were going to start changing drastically. And so I think the messaging to the teams internally, first of all, from a health and safety perspective, developing the COVID-19 protocols, making sure that all of our stakeholders understood what we were doing in order to secure the supply chain and also to stay safe. Those activities were put into motion. Also, we started understanding the fact that things were probably going to slow down. And so we started signaling that we might be potentially looking towards having some decreased hours and maybe some layoffs, which we're continuing to navigate, currently at this time. So again, it's just been an evolutionary process. It seems like it's been years, but it's only been weeks. And conversely, along with the damage control that we're currently doing, just understanding the dislocation that's going on in the marketplace today, and understanding that there's going to be opportunities, because from where we sit, certain aspects of the supply chain are going to be absolutely wrecked, and there's going to be opportunities going forward, and that's something that we always need to be mindful of.
Excellent. Tim?
Thanks, Tom. When Paul was talking, he described responding, I think in January, you said, Paul. I think we were later to the game. I think we started talking about this internally in late February, and I remember because it was before an LP meeting, but we really accelerated our approach in early March. It feels like a year ago. I mean, it's amazing to look back, and it's only a couple of weeks. If I try to simplify how we approach things, I'd sort of break them into 3 buckets. The first thing we focused on when we understood the scale and the intensity of the problem was business continuity, and we happened to be going into an LP meeting. And we wanted to be able to describe what our companies were doing from a business continuity standpoint. So we reached out to all of our CEOs and CFOs and asked them to put together business continuity plans. The good news is they were already either working on them or had them already on the shelf, ready to pull off. I've been really impressed with our management teams. They've done a fantastic job on the business continuity side. Creating dedicated teams to focus on it. Among the executive group, and then communicating regularly with the employees, following CDC guidelines. Figuring out what's going on with customers, communicating with customers, making sure that they understood we were still in business and would be available to help them as their business condition evolved. And that was both direct communication and then also through the websites, and obviously reaching out to vendors as well. So the first area of focus was business continuity, employee safety, making certain that we were doing what we needed to do to ensure that we could operate effectively and safely. Then very quickly after that, the focus was on liquidity, cash forecasting. Like a couple of the other panelists, I spent a large chunk of my career in the turnaround space. So this is a program that's pretty familiar to me. We had each of our portfolio companies working with Southfield because we wanted to be engaged in the details, put together 13-week cash flows, rolling 13-week cash flows, then going out monthly beyond that, integrated with a P&L model. And then we asked for weekly variance reporting. And we started that effort off early in March so that we would have the information we would need to understand the liquidity situation at our companies. We also immediately challenged the management teams to put more horsepower behind our collections efforts, because in situations like this, the first thing you think about is your customers are gonna either stop paying you or gonna slow pay you, and you want to be ahead of the curve on that effort. Make sure that the right people are focusing on it, that it's not something that's getting sort of pushed to the side while people focus on other things. We also very quickly reached out to our lenders, and we didn't have a clear agenda for those calls, meaning we weren't ready to go with an ask, but we wanted to find out what they were seeing on the ground, how they were doing, understand if they were having any issues that might impact us. We also wanted to tell them what we were doing so they would understand that we weren't sitting on our hands. So we had those initial phone calls with our lenders while we were getting the information internally to understand if we had anything we needed to ask from our lenders. Subsequent to those initial calls, as the liquidity information came in and we're running it against different scenarios to understand sort of whether we had any risks or pressure points, we started having conversations with lenders about potentially getting covenant, relaxing covenants, changing covenants, the fact that we were going to draw down revolvers. We felt that was an important, precautionary measure, even if we didn't immediately need the cash. And also, obviously, to the degree, if there was a situation where we needed to put equity in, starting to have those conversations. So we started having more strategic conversations about liquidity covenant structure. And then soon thereafter, as the government program started coming together, PPP and others, we focused on that. And we actually had I think this is a good idea if you haven't thought of, haven't already done this, but we had one person in our firm focused on that effort, gathering the information, talking to attorneys. So we had one sort of resident internal, expert to give us guidance on, which of our companies might be able to access these programs, how do you access them, and I think that was very helpful. And then the third thing, the third thing we're doing, which is it's the piece that's probably going to evolve the slowest, but it's starting to happen now, is business planning, the longer term stuff. Thinking about, in some instances, cost reductions. Do we need to take cost out of the business based on what we're seeing, not in the short term from a liquidity, right now we've got this immediate, problem, but what's the business going to look like 4 months from now, 6 months from now? And then the other thing that we've been talking about is not forgetting that, we want to be on offense at some point soon, and using this time for, if people are at home and they have extra time, let's focus on some process improvement efforts that we've maybe pushed off. Let's accelerate, some things that were hard to get focused on, hard to get done when people were, working on, 60-hour weeks, and start to position the business for being in an offensive posture when we come out of this. We're teed up for new customers, new verticals. We're communicating with existing strategic accounts to make sure that we're, really understand their needs and are ready to, push harder when appropriate, and then continue to have conversations with acquisition targets. So, we don't want our businesses to forget that we are going to survive this, and when we come out, we want to be, leaning in and back to growing the business. So those are sort of the three, business continuity, liquidity, and then business planning that have been our focus.
Thank you, Tim. Kevin?
Yeah, thanks. I guess I agree with what Paul said, and a lot of what Tim said is kind of what I was going to go over again, but I think it's kind of what I'll call the standard turnaround playbook, right? You start looking at your payables, looking at your costs, looking at your people, and the big thing there is communication. So communication with your people, and you're gathering all that information so that you can communicate to your lenders who you want to be on your side. But I think there's also an area that I think is very important, which is communication with your customers. And it's really this is a really unique kind of a situation we're in. And it's really hard to communicate with your customers kind of as partners. But to some extent, your customers need you and you need your customer. And in the beginning, everybody's going to tell each other, don't worry, things are okay. Don't worry, I'm going to pay you. Don't worry, I can provide you that stuff. And, kind of at the private equity level or the board level, you're really not in touch with those customers. So how do you get the guy who deals with the customers every day to be able to understand what it is you need to know? Is that customer going to crap out on you? There's going to be, as Paul said, there's going to be a lot of dislocation, and that's going to create opportunities because customers are going to crap out on people, and where maybe they wouldn't take your phone call, now they're going to say, hey, can you do this for me? So I just think that these guys on the ground that are dealing with the customers every day, they need to kind of understand how it all works, and they need to be out there, talking to the customers and bringing information into the people who can act on it. So that was, a key point outside of what those guys were mentioning. And I just think, going forward here, we're going to be in for a long, hot summer. Even if they take the gloves off now, you've got a lot of people that have been not working for, a month or 2 months or something like that. And they're not just going to run out and start spending money. It's going to be a long slog through the summer. And I think too, if you think about the banks, they're getting their first reporting in now on Q1. And Q1 is not going to be good, but Q2 is going to be worse. And they're not going to see Q2 until July. So they're going to be overwhelmed, which means they're probably not going to do much. And, but I think, you know, when you start thinking about Q3 with October, that's when, you know, the banks probably will have triaged a lot of opportunities. And so, you know, you're still probably 90, 120 days out before the tsunami hits of, you know, real problems. And the companies are going to experience that ahead of time. They're going to have customers who don't pay them, you know, all the things, all the bad things we know that are going to happen. And so I guess that's just kind of a prediction for the future. But I do think if you have capital, that's going to create lots of opportunities.
Okay, thank you. So we'll get more into the future later, but let's hear from Britt on, he's got a deal in the market currently, and tell us how the lenders are responding, what's going on with that.
So it sort of feeds into a question later where you ask about what is the current status of, you know, the M&A industry. And of course, it's mostly shut down and volume is down tremendously. But I happen to be working for a client on a buyout where it's been in the works for many months now, and it was teed up to launch into the market in March. So here we are. So we obviously had to ask ourselves some serious questions. Is it even rational to launch out into the marketplace? But really key primary elements are as we went through March, the monthly numbers were actually holding stable. So while most businesses are certainly suffering, in fact, the vast majority of businesses are certainly suffering, there are businesses that are actually doing well, you know, food distribution, e-commerce, you know, et cetera. This particular business and healthcare services, we're holding up its numbers of hours of billing and such. And so our flash numbers at the end of March are actually, revenues are up 1%. So it just happens to be one of those businesses that is performing well. And there's a reason why that is. It's not a fluke. And frankly, April is anticipated to be performing the same. So based on that, and you know, the buyer still wants to buy. They had a fair and lower valuation, and the seller still wants to sell. They're getting older and retiring. So the due diligence actually is complete. So the Q of E is done, the industry reports are done. So we were fortunate in that regard that, you know, sometimes timing is not good, sometimes you're more fortunate. So we decided to continue on and launch into the market. So we are. Now, of course, I'm engaged to raise the debt. As I'm talking to lenders, as you can imagine, I'll estimate and say something like 2/3 of them are saying, thanks, Britt, but you know, give us, you know, many weeks to just be totally focused on our portfolio. And then, you know, then we'll emerge back out and we're happy to talk to you at that time. For the other third, call it, you know, they are showing preliminary interest. It's really my job to sort through that crowd and figure out who is actually really real and who, you know, there are new business, you know, origination folks that are sitting there. So they're obviously willing to look at things. But I actually was in dialogue with one of the new business originators who he said, look, we're totally focused in portfolio. I go, well, what about you? He goes, I'm focused in portfolio. And I asked, so you're reviewing AP agings and things like that? And he goes, not only am I doing that, but also reviewing check runs. So really surprising response. Obviously that's not across the board, but that was one response, but just an illustration that many are totally portfolio oriented. But for the crowd that, you know, certainly every lender has challenges in their portfolio and they're going through triage, but those that are in a little bit better position and certainly have capital, they are looking at their new business pipeline and I would say, you know, much of it is being dropped, but for those few deals that are showing stable revenues and good valuations and sort of the basic metrics of things that that they're, you know, have as priority, we're continuing into the dialogue. And, you know, I would say the majority of the lenders are out, but there are a few that are in, maybe more than a few. And then, of course, certain lenders have different industry specialties. So in my healthcare services deal, talking to lenders that are focused in healthcare services, so they already have a understanding and expertise in that space. So getting real traction from a much thinner list of real eligible participants that are willing to do deals in this era. And then, of course, as you get to the end of the spectrum, there is the whole, you know, restructuring crowd, the special situation crowd that are, you know, many of those folks have been sitting on the sideline, not doing too much. And now is their moment to be active. Of course, cost of funds are higher, their yield expectations are higher, but that's another category of opportunity.
Thank you. This has been useful. A couple points. I think that right now people are focused on the portfolio, and it's a triage. Companies are putting their efforts into where it's most materials. Now all companies aren't the same. Some are actually like in food, grocery, and or certain type of healthcare, and actually doing better. Some companies also, I've been advising a company that's related to, they were in the consumer providing balloons and helping switch over to providing plastic gloves that have more of a market opportunity. But in general, cash is king right now, and people need to use the typical turnaround things, look inward, and do everything they can to preserve themselves. This is probably going to go on a lot longer than I think a lot of people are believing. I think there won't be normal until a vaccine is out, which will take at least a year, maybe longer. And there'll probably be a change in consumer behavior, as well as with so many people losing their jobs, people are going to be reluctant to spend. So you need to look at kind of worst case and prepare for that. It's too much to get in. We put a blog on the Ravinia Capital website that is advice for business owners and private equity owners, the steps to go through, the resources available at TMA. Once you get through that, and then you're going to need to look at the government programs and assistance. There's certainly been a lot of communication about that. As far as private equity goes, it's really up in the air. There's been a lot of talk on the, can they apply for the 500 or less employees and the affiliation rules. The industry itself has been trying to relax those. They've been partially successful, and there are exceptions like for SBIC funds, for people in the hotel industry and restaurant industry. But on the whole, they haven't been very successful now in getting those to apply. So when you get through with all that, you need to make decisions at some point whether to preserve your company and whether to put cash into the company. And those are going to be some tough decisions. We recently at Ravinia Capital put out, my partners John Kemp and Rick Bendix put out an article to help. And if you're going to put money into a company, be careful how you structure it. If you just put that in as just a cash into the company and it's considered common equity, if the company does go through a bankruptcy, you will lose that. So there's ways you can talk to your attorneys to structure it as a last out on your senior loan, and various methods that can protect that cash. So you want to be careful. But those are going to be tough choices. But also private equity is struggling with whether to draw down their lines of credit, and also if they need to go to their limited partners now and ask for different funds. And I'll ask the panel to comment on that, but some of them are suffering from their limited partners from the denominator effect, in the sense that since the public markets have gone down faster than private equity gets marked down, people are out of balance and might be reluctant to give more money, and these could be long-term decisions. Paul, I know you were going to talk a little bit about that communication with limited partners.
Right. We have a couple guys, but for the most part, just keeping that open line of dialogue has been key across all the stakeholders. So I think from our perspective, as we talked about earlier, I think it's situational. We're in a unique spot having manufacturing holdings. I don't think we're in danger of going away anytime soon, but the liquidity issue is something that has crept on the radar screen. We are seeing tier one suppliers start to slow pay us because auto and aerospace have essentially shut down for the last 3 weeks. And so it really just becomes a liquidity issue that we'll just have to solve internally. But to, I think, everybody's point here, communication with everybody across the board is key, and just making sure that everybody understands the situation and the metrics that everybody needs to hit. But it's something that we're literally monitoring on a day-by-day basis.
Thank you. Okay. So as far now, we'll shift focus to what's going on in the current market. And I think, as Britt alluded to, what I've been hearing with our own deal flow and with other people is the vast majority of deals that were in the marketplace are now either on hold at best or suspended. There are some deals still going through. We have a deal that's looking to close in a week or so that relates to important intellectual property that can still have value. So things that have value are very close to the finish line. Some of those are moving through, but the vast majority of deals are on hold. And deals that were in the pipeline ready to go, those are also on hold. As far as where the market's going to be, as far as there's a lot of speculation that it's going to be a lot of distressed deal flow. It's hard to say. I remember back in 2008, 2009, there were certainly a lot of additional ones, but it never really materialized the way that people thought. Banks were basically extend and pretend, or there was the saying, a rolling loan grows no loss, and basically banks didn't push hard. They gave time, and the portfolios came back and recovered. This time is probably different in the sense there's a lot of capital out there. We went into this with business loans, extremely high levered, so we'll see. But let's put up the questions, and then the panel can kind of talk about them. So Lena and Marisol, if you could maybe run the questions, and we could see what our viewers think.
Let's see if we can get this to work.
All right, there we go. So the first question is, how long before deal activity returns to recent volumes? So let's see what people think. This should be interesting. Okay, and it looks like 40%, the top answer was 6 months to a year, and then second is 40%. So people are thinking that really it's not going to return for, at least 6 months. And I think that's true. Let's go to the second question for 2020. How bad do we, what do we see the returns on private equity portfolios? Panelists, do you agree that it's going to take 6 months or more than a year on that first question, but while we're waiting for the results?
That's what I voted.
Yeah.
More than a year.
there still is a lot of cash out there. There's $2 trillion now in private equity. There's interest rates are now at the lowest point since 2009. But I think people are going to, have come out of this a lot more cautious. We've certainly been in a seller's market for a very long time with high multiples, high leverage. So it's going to be interesting. I think there'll be a much more, for a while at least, conservative structures. I think you'll see more loans of asset base and cash flow. I think you'll see investments, maybe some preferred equity type of. I think there's going to be a lot more conservative structure as well.
One of the things that, Tom, one of the things that concerns me as a buyer in the lower middle market, and I'm not as concerned about this with our add-ons for existing portfolio companies that are on this, often very small. But a lot of these owners have a number in mind, and and you encounter that regularly, during the best of times. They've talked to somebody about what their business is worth, and I think it's going to be hard. Those folks who are confident about their businesses and have a number in mind are going to say, I'm going to wait until my business bounces back and it feels like a better time to sell. I don't need to sell in 2020. I can wait. I could maybe wait 2 years. It's worth it to me to get back into a frothier market condition. So that's one of the things that concerns me. I'd be interested if any of the other panelists agree with that outlook.
Hey, Tim, I have a thought on that. I know just based on what we're seeing in the market that there are firms that are going to be staring into the abyss. And I think an opposite way to look at that, perhaps, and again, everything's going to be situational, right? But if owners had that number and they are currently staring at a situation where they might not even be in business if things continue for the next 30, 60, 90 days, they might be happy to have any sort of an exit once this whole thing emerges, if you will. So I think we're probably going to get both, right? We're going to have people who are holding on to that number as difficult as it may be, because it's a different world, right? But on the other hand, I think people who are founder-led, that are just basically getting tired of all this, and then they get hit with this. So I think it's going to be an interesting environment as this crisis continues to move forward.
And exactly what Paul said, but if you are sponsor backed, then you have some capital to help you get through a big long storm. But Paul, just what you said, the founder family owned business that has been hit really hard, they just don't have the capital to put into a business to get it through this period. And I think, like you're right, they're going to be in default. They got their lenders talking to them. There's no big capital to come in. They're going to be stuck.
We've been talking to probably 3 or 4 people in manufacturing businesses, nice sized businesses, very nice businesses, but the average age of these people, I would say, between 75 to 80 years old. And it's exactly what you just said, Brett. Their wealth is tied up in that business, and they just got, a hockey puck to the head. So they're going to have to deal with that reality.
Do we have answers to the second question? Do we get results?
We did get results. I
Moment.
was on there for a moment. Let's see if we can pull it back up. I just want to be mindful of the time and make sure that we get to some Q&A, but let's see if we can pull those results up. Otherwise, we'll move to the next question.
Okay.
Can you all see them?
No. Let's try the next one.
Let's try the third, and then we'll move to Q&A. Oh, there's the result. So most people thought the returns would be between 0 and 20% or worse. Only 6% saw positive, so it's not really a surprise. So the final question for our audience. This one's going to be interesting. It's on where multiples will be.
Multiples of negative cash flow?
That's true. People often ask me, well, what's the multiple on distressed deals? You know, that's a tough question to answer.
Yeah, because if you have LTM numbers where your recent 2 months fell off the cliff, what are you basing your multiple on?
Yeah. So here we go. So everybody can vote on where they see the multiples will end up. Certainly a lot of people that have been private equity for a long time have been bemoaning how high the multiples have been. And so this maybe is the time that they'll come down, but there still is a lot of cash out there and a lot of available leverage and low interest rates.
My answer is biased because I tend to focus in the lower middle market. So 3, 4, 5 million of EBITDA is where I tend to spend my time. So that's a different world than, 10 million plus of EBITDA.
Okay, so let's see if we can answer some of the Q&A. We've got a lot of questions, but not a lot of time. Has anybody submitted business interruption insurance claims? We'll try to rapid fire these.
We have not.
No, I think there are a lot of litigation's going to come out of this, so I think the lawyers can expect to be pretty busy, whether force majeure clauses and MAC clauses and insurance claims. There's going to be a lot of work coming out that keep people busy a long time. Has anybody drawn their credit lines?
Yes, we have, we in consultation with our lenders, we drew on all of our credit lines.
Okay. Britt, a question for you. As the valuation on the live deal, has it changed?
It has not. Based on the stable revenue, and frankly, the valuation was on the lower end of the spectrum to begin with. So it has not changed.
And somebody said, are you willing to risk your own personal capital in deals now?
Yes.
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 Yeah, I think obviously it depends on the deal, but this is potentially when good opportunities come up, when good companies need help. That's a way to everybody can win. There's a long.
Sorry, I was just going to add. I mean, we're still actively looking at add-on acquisitions for our portfolio companies because we had some ongoing conversations, and they're typically slow-moving conversations because they're not, they're not advisor, but led efforts. So we're definitely in business.
I think there's another place for opportunity too, which is in the corporate carve-outs. When the stock market is booming and you're in a big corporation which has lots of pieces to it, it's hard to get rid of one of those pieces unless it's accretive to your overall company. But when you get a time like this, where first quarter and second quarter, the CEO, CFO is going to put in huge reserves for losses, and they're going to be able to provide for getting rid of all the cats and dogs that they didn't want to have anyway. And so I think you're going to see a lot of activity coming out of the corporations for, let's say either some cash cows that don't get high multiples or whatever. So I think that could be a real place for opportunity, but probably not till the fourth quarter.
Question for Tim. Is he seeing an impact with NITVIA, and are they still looking for add-ons MSPs in the near term? How do they get comfortable with B2B MSPs where you don't know how much they will be affected? I'm sure I understand that question.
Yeah, so we have a portfolio company that is an outsourced IT services provider. The acronym MSP, Managed Service Providers, is typically applied to that industry. They have been extremely busy, as you can imagine, given that so many companies had to quickly move from people working in an office setting to working remotely. And we have seen new business continue to come on board at actually a better than normal clip. What we've been focused on there, and you brought it up, is looking at our customers and trying to understand how exposed they are to this. So luckily we don't have a lot of direct exposure. A lot of our clients are not restaurants, hair salons, companies that are shut down as a result of this, hotel chains. But we have seen some of our clients reduce service because they're furloughing employees, and our contracts are on a per employee basis. So we are seeing some shakiness, but in general, that business is performing quite well. I think it's one of the better places to be in this incredibly difficult time. And then the answer to the other question is, as I said, yeah, we're still looking actively at add-on acquisitions, but I think when we look at them, we're having to apply the lens of what kind of customers do they have, what's the impact of COVID-19 and social distancing on their customers. And I can tell you, with one of the potential add-ons that we had, that's definitely something that we're looking at closely.
In the absence of debt funding, are private equity going to do 100% equity deals, or would they bring in bridge financing? What's that?
Or call me.
Yeah, I think they would, but I do think that they're going to be able to find loans. I think it may be on a more conservative basis on the collateral, but there will be, I think unlike last time, the banks are healthy, and there's certainly a lot of support coming from the Fed. Just today, the Fed came out with the Main Street Lending Program guidelines, which are for companies over 500. They're up to 10,000 people, and they're going to be providing loans between $1 million and 25, and they're going to take 95% of those loans, and the banks will still hold 5%. How worried are these questions? How are the banks will participate in further credit crunch affecting many companies and further exacerbating this downturn? So I think we think they'll continue. And then anything, will there be a distressed market and what to be concerned about? I think there probably will be, but I think that service providers really need to be cautious. Distressed deals are not the same as other deals. If you get engaged, we've learned this over the years the hard way sometimes, and if things go into a restructuring, your contract is not valid, and you may have to get re-engaged a second time or could lose the fees that you had. So be very cautious. Make sure that you engage bankruptcy lawyers to help guide you along the way. And like people on this panel that have experience in the distressed industry and aren't just coming into it right now to be opportunistic. I think now that it's 3 o'clock, we'll end the panel. We'll give everybody a chance for a last word, and then we'll end it and turn it back over to Lena. Panelists, any last words?
I'll start, I guess. Thank you for the opportunity to talk to everybody, and feel free to reach out if anybody wants to talk about any deals. I guess right now, my focus on looking for deals is we all see a lot of deals in the market, and there's a lot of deals that maybe you were looking at, you thought you had some kind of an edge in it, but then somebody came in and paid way more than you could ever possibly conceive of paying. And that happens a number of times. Well, right now, those businesses, if they've cratered and they're full of, lots of debt on them, those are probably good opportunities to make a second run at those things. So that's kind of where I'm focusing my prospecting time.
Thank you. Anybody else?
I'll just say that, as I was describing earlier, we're focused on the portfolio right now, and beginning to have conversations with bankers about other potential opportunities down the road. But really, we're spending most of our time with the portfolio, making sure that the companies are in good shape, and then starting to help them think offensively. How do we use this time to get prepared for growth going forward? We just don't think there's going to be a lot of opportunity for us in the next 4 to 6 weeks, but we think it will start to open up at some point. We want to be ready to engage. So we're looking forward to that time and are planning on being prepared.
I would echo that, Tim. We're heads down, just making sure that nothing goes off the rails over the short term. But again, just seeing the dislocation that's currently in the markets that we're in, there are going to be some significant opportunities, I think, within the next 6 to 12 months. So completely agree.
And I'll just finish up with a wishing all that might be in their religious mode of Passover or Easter this week. So everybody's separated from their families. So whether it's FaceTime or Zoom, do the best you can to connect with your loved ones.
Thank you.
Awesome. Thank you guys so much. And thank you, Tom, for leading this panel. I think it was very insightful. We had about 200 people almost the entire time. So really helpful information. Thank you again to our sponsors, Alliant, Brian Cave, and Baker Tilly. We appreciate your support. Everybody, thank you for attending. We will be sending out some follow-up emails. You will receive invitations to our webinars next week. We're doing similar formats, a lending panel on Tuesday, cybersecurity one on Thursday. So keep an eye out for that. We will be posting today's webinar on our YouTube. So as soon as that is up, we'll make sure to circulate that information. But again, thank you so much to all of our panelists. Really appreciate it, and looking forward to seeing you all next time.
Thank you.
Thanks, everyone.
Thanks for having us.
All right, thanks.